Hi, my name is Rajiv Bello, and I'm the principal and actuary of Colva Insurance Services. This is the third video in our series of how choosing the wrong life insurance policy can be a $21,000 mistake. In this video, I'll be showing you how to determine how much life insurance you need. We'll discuss how life insurance needs decrease as you get older, and why it's important to consider this prior to purchasing a policy. We'll talk about the importance of creating a financial plan, and how Colva can help save you from spending thousands on life insurance coverage that you don't really need. One of the most important questions that people can ask themselves prior to purchasing a life insurance policy is, how much life insurance do I really need? In order to answer that question, you have to first take a serious look at your assets and liabilities and how they change over time. For those unfamiliar with these terms, liabilities are financial responsibilities that need to be paid back. These are items such as your mortgage, credit card debt, and future college and retirement expenses for you and your family. Assets, on the other hand, are items that offer you monetary value and will help you pay back your liabilities. For example, your savings accounts, investment accounts, and spouse's income are all assets for you and your family. Your life insurance need over the course of your life is just the difference between the amount of your liabilities and the amount of your assets. This life insurance protection, in combination with your family's current assets, would allow your family to pay off their liabilities even if you were to pass away unexpectedly. It's important to note, however, that a couple's assets and liabilities change over time. A young couple has relatively low assets but high future liabilities. Generally, they don't have a lot saved in the bank, but still have a lot of future financial responsibilities, such as paying off their mortgage and saving for retirement and their children's college education. An older couple, on the other hand, has high assets and relatively low liabilities. Over the years, an older couple has managed to save for retirement while also paying down their mortgage and children's college expenses. Furthermore, their children are more likely to be out of the home and financially independent. Therefore, while a young couple may have high life insurance needs, as they get older, their life insurance needs will decrease. As we'll show you in the following slides, it's important to take this into account prior to purchasing any life insurance policy. So let's go ahead and take a look at an example to help illustrate some of these points. We'll be taking a look at a 35-year-old married father who is in great health with 2 small kids, who he hopes to one day send to college. However, he doesn't know exactly how much life insurance he needs, as he is neither a financial or insurance professional. The first thing he needs to do then, in order to determine how much life insurance he needs, is to create a basic, long-term financial plan. This is one of the things we do for free here at Colva. We create a financial plan for our clients and help them determine the amounts they need to save each year in order to meet their goals for paying for their kids' college expenses, as well as their own retirement. We then use this financial plan as the basis for determining how much life insurance our clients need. In the graph below, we've taken this 35-year-old father's financial situation and modeled what we can expect his liabilities and assets to be over time. The red line indicates his current liabilities and how they change over time as he gets older. The blue line indicates his current assets and how they change and grow over time. By looking at this graph, we can see that initially this individual's liabilities are high, as he has a mortgage and future retirement and college expenses still left to be paid off. However, as he gets older, he's able to start paying off some of these liabilities, and they decrease as he gets older. His assets, on the other hand, start off low, as he generally has a lot of liabilities, but not a whole lot left in the bank. He can just put a down payment on a house and doesn't have a whole lot in his savings and retirement accounts. However, over time as he gets older, he starts saving towards these goals, and his assets increase, until about his mid-40s or so, when he starts paying off his kids' college expenses. And then when he's in his mid-50s, they start to increase again after his kids have moved out, and he's primarily saving for retirement at this point. The gray area in between the red line, his liabilities, and the blue line, his assets, is his life insurance or death benefit need. So we can see here that this gray area, or his life insurance need, is high when he's at age 35. But over time, as the difference between his liabilities and assets decrease, his life insurance needs decrease, such that if he's planned properly, by the time he's ready to retire at age 65, he no longer needs life insurance. In the previous slide, we saw that the uncovered gap between a person's liabilities and their assets defines their life insurance need over time. Asset liability matching, or ALM, is the financial practice of properly covering the gap between an individual's liabilities and their assets. However, it's important to acknowledge the risks of both undercovering the gap as well as the risk of overcovering the gap. If you undercover the gap between your assets and liabilities, then you are essentially leaving your beneficiaries unprotected in the event of your death. Having a $100,000 death benefit when you have $500,000 worth of uncovered liabilities is a difficult predicament to leave your financial dependents in. However, overcovering the gap is a more realistic financial risk, as most people will live long lives well into their 80s and never really need the benefit from a life insurance policy. Purchasing a $5 million policy when your family only needs $500,000 is like using a cannon to kill a fly. When you overcover the gap like this, you are essentially spending thousands more on life insurance premiums for extra life insurance coverage that your family doesn't really need. These premiums easily could have gone towards something more worthwhile, such as saving for retirement or for your child's education. Unfortunately, most life insurance agents don't offer you a life insurance solution that properly covers the gap between your liabilities and assets over time. Instead, they'll generally recommend you purchase one long-term insurance product, even if it doesn't properly match your needs. Part of the reason for this is that the agent's compensation structure emphasizes sales as opposed to providing value. The commission that agents receive for making a sale is anywhere from 50% to 100% of the first year premium you pay, and is not dependent on whether that product actually matches your needs. Long duration products cost more than shorter duration products, and permanent policies can cost up to 5 to 8 times as much as a corresponding 30-year term product. So if a customer purchases a $2 million permanent policy for $3,000 a year, when all they really needed was a $500,000 10-year term policy for $300 a year, the agent is still incentivized to sell the customer the more expensive product, even though it doesn't really match his needs. This is because even if the policyholder buys the more expensive product and changes his mind a few years later and cancels it, the agent still gets to keep his full commission. The policyholder, on the other hand, is out a couple of $1,000s because he made a poor financial mistake. By not properly considering how their life insurance needs decrease over time, many policyholders often purchase expensive policies up front, only to end up canceling the policy a few years later once they realize they no longer need it or want life insurance. While this is a great business model for the life insurance companies, as it allows them to collect premiums on a policy while rarely having to pay a death benefit, it's not so great for the policyholders. This is why it's very important to consider your assets and liabilities and how they change over time prior to purchasing a life insurance policy. At Colva, we design an insurance solution for our clients that better matches their needs and hopefully prevents them from falling into the life insurance pitfalls I've previously described. In order to illustrate this, let's again analyze the needs of our 35-year-old male non-smoker and look at how Colva provides a better solution than a typical life insurance agency. The graph in this slide shows the client's life insurance needs over time and how Colva creates an insurance solution that better matches it, as opposed to the level insurance solution provided by typical life insurance agencies. The red line in the graph shows the 35-year-old male non-smoker's life insurance needs over time. We can see that while at age 35 he needs $1 million worth of coverage, over time this amount decreases such that if he's planned properly and is paying down his liabilities, by the time he's ready to retire at age 65, he no longer needs life insurance. However, the orange line shows a typical life insurance agency's recommendation, which is they'll recognize that he needs $1 million worth of life insurance when he's 35, but then recommend that he purchase that $1 million of coverage for the full 30 years. We can see, however, quickly the problem between this recommendation and his actual needs, and that is that over time, this life insurance coverage stays constant while his needs are actually decreasing, so the difference between the orange line and the red line increase over time. What this means then is that the policyholder is just spending thousands more in premiums for extra coverage that he doesn't really need. At Colva, we first create a financial plan to determine exactly what your life insurance needs are over time. We then recommend a solution, which is represented here by the blue line, which better matches your actual needs. Our solution consists of a 10-year term policy, a 20-year term policy, and a 30-year term policy, which better match your needs, as opposed to this level insurance solution, or the orange line recommended by the typical life insurance agency. So you can see here the difference between the orange line and the blue line, which is Colva's solution, is the premium savings that Colva offers you through this gray area here. We can see over time that the difference between the orange line and the blue line increases. In fact, by providing this type of solution to our policyholders, in this example, we would have saved this policyholder an average of $208 a year, or over 30 years, greater than $6,000, by providing our clients with a solution that better matches their needs. By providing this type of solution, our clients are better able to appreciate the value in their insurance as opposed to purchasing an expensive long-term policy from a typical life insurance agency only to cancel it a few years later when they realize the premiums they're paying are too much for the coverage that actually matches their needs. One thing you should notice though is that even with Colva's solution, which is this blue line, there is still some space between the blue line and the red line, which is the client's actual needs. For those clients who want to take on a little bit more risk and save some more on premiums, Colva will design an insurance solution that better matches their desires and needs. Well, that concludes the third video in our 6-part series of how choosing the wrong life insurance policy can be a $21,000 mistake. In the next video, we'll go over a numerical example that walks you through how choosing the wrong life insurance policy can result in you spending thousands more on life insurance premiums than you really needed to. You can find a summary and links to all 6 videos in the series in the YouTube description below this video.